Everyone, it's Erich Reimer. I'm here today to talk about the historic lows that rates across the board have been hitting in recent times. We saw this past week how the 10-year US Treasury yield hit around an all-time low of 0.7%, in line with the direction many bond yields across the world have been going in recent years, whether towards zero or now in the case of about $18 trillion of outstanding bond debt out there, negatives. And while for a long time US Treasury bonds have avoided that fate, it seems like now that is increasingly becoming possible with them. We saw just a few years ago how, even with a lot of turbulence going on in the world, Treasury yields still held around 2 to 3% for the 10-year, but those days are now long gone. At the same time, the Federal Reserve is cutting interest rates, with the most recent interest rate cut of over 50 basis points, making things such as high yield savings bonds, which have not really been seen since before the Great Recession, reducing the yields on those even further. And we'll see if in a year or so those high yield savings accounts are still around there. And so this creates a very difficult situation for many investors because a lot of people are uncomfortable investing in the stock market at this time when stocks are valued relatively high based on forward earnings in many cases, at a time when coronavirus and volatility are wreaking havoc across people's portfolios. Many people want to look for bonds, look for savings accounts, look for certificates of deposit and other money market funds, etc., that are seemingly safer. However, those instruments are now yielding barely at or even half of or even close to the rate of inflation. And so this really creates a difficult situation for many investors out there who are looking for a way to balance out their portfolios. Because let's be real, how much money can you really make off a bond that yields 0.1% every year? I mean, that's not even 1/10, 1/20th of the rate of inflation. And so this is really creating a difficult situation right now, I think, for many investors. And I mean, I think a lot of people are worried about whether the United States is also entering this quote unquote new normal that places such as Europe have now experienced, Japan, etc. Places where, because of a combination of a multitude of factors, black swan events, monetary policy, volatile stock markets, interest rates end up being held basically down to a minuscule level. I mean, we saw how after all the years of chaos in Europe that rates across even the most risky economies in Europe are nominal at best. And it remains really to be seen how things continue on in the future. However, it definitely is a difficult situation for many investors who are looking for a way to just have a balanced portfolio, to try to make some money, and to try to navigate a market situation which has not really been seen before in in modern history. I mean, never before have rates been this low across the board. I mean, there was times throughout history when there's been stock market chaos, but even during that time, those times, rates still were not nominal. And for the bulk of history, I mean, rates were, between 5 and 15%, in safe economies like the United States. But those days are long gone. And so, happy investing out there. We'll see how things go and keep a watch on those yields.